So, good morning, ladies and gentlemen. Good morning, ladies and gentlemen. Um, we had some technical difficulties this morning, having to go to the latest version of our software. Now that we got everything up and running, we are in here. We didn't get any of the down move. I'm disappointed in that a tad bit, but all we do is just wait on our opportunities to flow, and that's what we're going to do. Um, as I told everybody else, this morning, we are definitely down today after the market made a big move. I talked about this all last week, when I said it's getting up into a resistance area, and you had a high probability of the market potentially making a down move at the beginning of the year. Well, that's what it's doing. I just don't know how sustained the down move is going to be. So we just have to kind of wait and see. But I will tell you this: if price closes below this 87, 787.75 area, maybe even 760 area, if she closes below that area, you're gonna have to be very, very careful about the longs to see what is going. So with that said, we're on to our daily, just looking and seeing what we have going on here. And we'll just wait on our intraday opportunities here. What I was talking about earlier, Quentin, is everything is green and green, but what we want to do is we want price to now come down and retest these lows on this larger time frame and fail, and then we'll get the move back up. We don't want the move up now because it's mature and in old age right now, as far as this up move is concerned. And we want it to come down and regress, and then we'll catch the move back up, right? That's what we're waiting on now. Other than that, ladies and gentlemen, I'll go on mute. I'm going mute and turn the video off, and we're here waiting to see if the market makes a move. In between time, I'm going to put Quentin on the spot if he doesn't mind. And I love what you were playing there earlier, Quentin, on the how to turn $5,000 into $1 million. Do you have that queued up or no?
I have it queued up right now, chapter 1.
All right, cool. So what I'll do is I'm going to go on mute, but in the background, you will hear, you should be able to hear the audio book playing in the background. So cue it up for me, Quentin. Just want to make sure everybody can hear it.
10-4.
Chapter 1. Can you become a millionaire on the stock market? Without a doubt, every trader is interested in the question of how to trade a small account up. How do you manage to increase this, usually small, seed capital? Or better still, how do you manage to make a small fortune out of this small sum? Preferably, as fast as possible. As soon as the money is in the brokerage account, most traders usually start looking for some kind of holy grail method, which sometimes takes years, as long as there is still money left. I would like to point out my views of things in this book. It will probably surprise some, and will certainly upset others, because what I have to say on the subject may not suit everyone. Those who have read my other books know that I am critical of the idea of making a fortune out of a small capital investment. Yes, there are traders who succeeded in doing this, but they are few and far between. And above all, there are very few who have done so with the traditional short-term methods. The goal of USD 1 million is a very high goal for most traders. In fact, some would say that 1 million is the sum you should bring with you when you go to the stock market. As the reader, you possibly know that even this kind of money is no guarantee that you will be successful. Most traders do not have so much capital when they start anyway. So the question is quite legitimate. Once you have made the decision that the stock market is the best way, I know someone who made his first million selling ice cream. What do you need to do if you want to earn $1 million? Big goals need big perspectives. If you plan to earn USD 500 with trading, then you need a different perspective than if your goal is USD 1 million. This book is about how to adopt such a perspective. Unfortunately, many traders try to reach this goal by sticking to the USD 500 perspective. I just need to reach this modest goal for enough days in a row, they say. Then I'll get to the million on my own, sooner or later. As a rule, these traders never reach their goal, and I firmly believe that the reason for this failure lies in their incorrect perspective. It is like looking for 5-cent pieces on the street. No doubt, you could become a millionaire by collecting 5-cent pieces. But in my opinion, that would take much too long. Incidentally, I only came to understand this simple truth gradually. I was one of those traders who looked for 5 cents every day. The tragedy of this approach is that every now and then, you actually will find a few 5-cent pieces. That little surge of happiness that one feels makes one think one is on the right track. No doubt, the person who collects 5-cent pieces will reach his million one day. For example, if he finds one of those coins every day, he simply needs to repeat the success for the next 20 million days. I think the reader will see the absurdity of this idea. So, if you set yourself a high goal, you should look for ideas that will get you to your destination a little faster than our brave collector of 5-cent pieces. In this book, we will look at how one can find such opportunities and what perspective we need to adopt, rather than walking around with our eyes glued to the sidewalk. I would like to present the reader with a strategy that, in my opinion, makes it possible to make a fortune on the stock market. I am not saying that this is the only way, because there are thousands of ways to make money on the stock market. But it is a radical method, because it assumes that, under normal circumstances, the trader with a small starting capital will not be able to achieve this. Nevertheless, the possibility exists to make a fortune on the stock market with just a small investment, by procuring the missing capital from another source outside of yourself. The strategy that I present here starts with the assumption that the trader cannot achieve this with his money, but only with the market's money. He will have to learn to get the money from where it is, and he'll have to do it with chutzpah. In other words, he will have to take some serious risks. I think that speaks for itself. To say anything else,
let's go ahead and pause that for a second. We have a situation brewing here where we have alignment, but we haven't had really a retracement, which gives me a reason for pause. But if it sets up, meaning that come down and give us a market structure on the 900, and in addition to that, it gives us a 2B on our 300, an ABC pattern on our 300, then we will entertain that thought.
Are you speaking because it did breach that line on the 8100?
Right, because it closed above, and now we're looking to see if she's going to pull back. We're looking now to see if
pullback on the time, right?
We're looking for a market structure on the 900.
All my indicators say that we're looking for a pullback and looking for a long.
That is correct.
Okay. And on our positions today, are we focused on the micro or the mini?
We're focused on a micro, but we're probably going to go in 2 or 3 minimum. Okay. But and we're looking to add it turned red. It turned red there. So since it turned, it's flip-flopping. It's flip-flopping. All right, what we're gonna do is we'll go. No, it's let it go red first. Let it go red first. Let it go down, because that's not the first trade you want to take for the day. Remember I told you I wanted to pull back on the 8100?
Yeah.
It really hasn't done that yet. So we can go back to listening to our book. We're gonna wait for the pullback on the 8100
Oh, I
before
thought you
we.
were looking for the pullback on the 900. My bad.
So yeah, I
Yeah.
was looking for the pullback on the 900, but it hadn't pulled back on that 8100 yet. And to test it, and this may or may not work, but you don't want to be in this because this move is very mature, meaning that it made a big move to the upside already from the bottom, and it went from 880 to 760, and I went almost 100 points. And now we're trying to get into the trade, which is probably not the best move for your first trade. If we're already up, we could take a test position. But because this is going to be our first trade, we want to sit and wait on everything to be lined up. So we can go back to playing the book, and
I
then
think it's about to shoot up for real.
see, that's what we want to avoid. We don't want to. We want to get into the habit.
Okay.
We want to get into the habit of when you're looking at it, look at your rationale. Now, thing is it up? Yes. Has this trade worked? No, because it gave you an entry at 67 here potentially, but this literally would be the fourth move. Yeah, because the thing is that the 900 never went. No, 900 never went into a downtrend, then came back into an uptrend. This is a steady uptrend move up to the upside, and this is the fourth move, and we never got in on the first one. I'll expound on what I'm talking about. This is all one move to the upside. So, and we didn't get any of this. Now we try and get it up here. That's probably would not be the best move. That's why it's herky jerky right here.
Yeah, I see.
That's why it's not. It's not. I'm not saying if it breaks through here to take off, but if it comes down, you're gonna be mad with yourself. So, because this is a 50-50 shot, and if there's no bet in the coin toss, then we need Ray Charles here trading for us.
Not the Ray.
I'm sorry.
Not the Ray Charles.
No, we don't. And right, you see how that trade just stopped you out. Had you taken it, because just because it's a setup, ladies and gentlemen, does not necessarily mean it's a trade. Setups and trades are different because you have to, in order for it to be a trade, you have to understand what the mood of the market is. And the mood of the market right now is we need to chill and wait on it. Wait on the 8100 to pull back some. So that's what we want to do. And Quentin, if you could start that again, I'd appreciate it to give people something to listen to.
10-4.
Just as it is possible to build a real estate empire without a dollar of equity, so it is possible to build a large trading account within a relatively short time with a small starting capital, USD 5,000, or even less. I am contradicting myself here because I have already said in previous books that this is not possible. What I meant was that it is not possible to do so with conventional trading methods. In other words, you will have to go to very unconventional ways if you want to achieve that goal. Chapter 2. Trade with the market's money, not with your own. My best year of trading was 2008, but most of the money I got did not come from my day trading or scalping. Although those methods also worked well that year, most of my profits came from a single trade. A single. I earned more with that trade than I had in the previous 3 years. This experience was a kind of breakthrough for me. These are the kinds of moments when you discover completely new possibilities. That was the case with the one trade with which I made a 6-figure sum. It was the time of the financial crisis. Lehman Brothers was broke. The stock markets had plummeted. Almost everyone was sitting on big losses, while I was able to reap the biggest profit of my trader career because I was standing on the other side. No, I was not short in stocks, even though that would have been an excellent idea. I was long in silver. That was my only position at that exciting time. Long silver. I was convinced that in a crisis of confidence of this magnitude, subprime crisis, it would be a good idea to buy so-called crisis currency. Investors like to park their money in markets that are considered safe havens in times of turmoil. Traditionally, these are the precious metals, especially gold and silver, of course, but also currencies of certain countries, such as the Swiss franc or the Norwegian krone. At the time, I did not understand that this also included the US dollar. Escaping the risk usually helps the markets that are considered relatively stable or low risk. I chose silver because I assumed silver would outperform gold in this crisis. This assumption turned out to be correct, but unfortunately, it did not really materialize until 3 years later, when silver climbed to stratospheric heights in the wake of the euro crisis. Still, my silver trade of 2008 was a success, though the movement on silver in early 2008 was modest compared to what had happened in 2010, 2011. I started building smaller positions in the range of around USD 13 or USD 14. During the subprime crisis in late 2017, these first positions turned to profits quickly and easily. After a few days, I already had a book profit of over USD 1000. Not bad, you might think. And under normal circumstances, I would have been happy with that gain, and I would have sold the position. Incidentally, I did not intend to keep that trade going for long. I gladly admit that the trade was intended as a day trade. Once the position had gained nicely, I thought, why not keep it going a little longer and try to get more out of the trade? And indeed, silver rose the next day, and I had the courage to buy another contract. But you have to be aware of the hysteria of those days. The media was full of bad news, not to say catastrophic news. The stock markets plummeted worldwide. And when the news of the Lehman Brothers bankruptcy on the ticker came on September 15th, the dam broke. The crisis was complete. My silver trade, on the other hand, did very well. The more the silver price rose, the more contracts I bought. A few days later, I already had 5-digit profits. But if you are now thinking that such a profit would lift you to a permanent state of elation, you are mistaken. Prices do not go straight up. I wish they would. Not at all. When markets go wild and volatility picks up, prices fluctuate so much that they can go just as widely the other direction. I remember that my silver position was USD 17,000 in profits one morning, and only USD 12,000 in the afternoon, due to a correction. A book loss of USD 5,000 in just a couple of hours. That was much more than I would allow myself under normal conditions. But you have to be able to live with that if you want to increase your positions systematically. Let me point out that I did not have a smartphone at the time. I'm a bit old-fashioned. Having a number of contracts in a trend market is a disconcerting thing. Actually, great success is also somewhat disconcerting, which is why most people prefer to live without it. So, I had to open my laptop every time to see what was happening to my silver position. At the beginning of January 2008, silver struck a resistance of about USD 15. This resistance had lasted for 2 years. I had placed several stop-buy orders above this level, all of which were executed when the outbreak came. Soon, I had doubled my position again. Now it became really exciting. The fluctuations in my account were now quite wild. Within a minute, I was several $100s richer or poorer, and soon it was to be thousands of dollars. See Image 1, Silver Monthly Chart, 2006 through 2019. I remember well that I felt I was on the safe side with this position. I knew that I had a winner, and that all I had to do was rigorously trade the upward movement in silver. This was an extraordinary situation, because I had only a few thousand euros in my brokerage account. I used it to experiment and perform occasional swing trades if I saw an opportunity. If I remember correctly, I had about 2,700 euros in that account. Not much, considering that thanks to this one silver trade, I eventually had a book profit of more than 40,000 euros. So within a few weeks, I had made more than 1,000% profit, thanks to the leverage I used and the fact that I traded with the money that was on the market. That was the whole secret of this trade. I did not trade with my own money. I traded with the market's money. I suggest that we take a closer look at this, because some readers might not understand what I'm saying. If you buy a property and finance 70% of it, you are basically not buying this object with your money, but with the bank's money. The bank pays for the major part of this property because it considers the property as collateral, and the house remains the property of the bank until the last installment has been paid. Something similar happens in the stock market. Once you have book profits, as long as you do not realize these book profits, you do not sell your position. That money does not belong to you, but to the broker. However, this book profit allows you to buy additional contracts because they will be credited to you through the daily settlement. So, this book profit allows you to buy a larger position than you would have normally been able to buy with your small capital. This is a comparable leverage, as if you were buying a property with a loan from the bank. And of course, you cannot call your accumulated book profit your own until you sell your position and earn the profit. But as long as you do not sell, you can continue to buy provided you are still right in terms of the market direction, and the trend continues to grow in your favor. This approach is very different from closing your position every day and reopening it the next morning, which is what a day trader does, for example. At first, day trading seems less risky, but it is easy to forget that every day, the trader carries the whole of the risk. He risks his money every day. His own capital is fully at risk. However, if you do as I did on the silver market in 2008, at some point, you will no longer be risking your own money. You will begin to speculate with the market's money, thanks to your book profits. Technically, you may not see the difference, but in terms of risk management, the difference is huge. As soon as your first purchased contracts run into profit and your book profit increases, you have a free trade, so to speak. From that moment on, you can use your book profits to expand your position. So you do not buy with your own money, but the market's money, or with the bank's money, if you will. Moreover, I think that you should not keep the leverage on your position too small when you find yourself in this comfortable situation. Quite the contrary. From now on, you should really grab the ball and expand your position seriously, because that is the only way you can make real financial progress. The same is true for the clever real estate investor. He does not buy his properties with his own money. He buys them with the bank's money. And the more properties he owns, the more he buys. It is a proven concept. If you research a little, you'll find that apart from those who have built a successful business, most rich people have become wealthy with real estate. Over the course of January and February of that year, silver rose to...
I'm gonna pause it for a second and see what's going on. Pausing for a second. You see what's going on right here?
Yeah, but there's nothing you can do because it's already made the move. This is what I was talking about. They gave you plenty of opportunities, but it was stop outs along the way. So this is literally what you call a breakout move. So now what you have to do is wait for the pullback now on the 900 if you want to take this trade, because it did try to go down on that 900. I mean on the 8100, excuse me, and it couldn't do it. So that means that it's probably got some upside to it, but you got to wait on the pullback on the 900 to see.
And that's what I was referring to, a pullback opportunity.
Yeah, pullback on the 900. That's what we're waiting on now.
We're just doing right now, actually trying to, last 3 bars has been trying. Okay, I'll start back playing again, but I'm just kind of
I keep your eye on it. I get you 100% because I'm watching it. He's one more. It needs to get below the low of this bar. If it gets below the low of this bar, we consider looking for a trade.
On the 8100?
No, it gets on the 900, and that 900 needs to make a market structure right here, which means we need one more bar to get lower than this bar that's forming now.
I got you. All right, I'll start back playing again.
While it was on its way to the top, I bought more contracts. In the end, not as aggressively as in the beginning, because after studying the chart, I had the feeling that at some point, silver was going to reach a peak, and then the inevitable correction would occur. This feeling was soon to come true. In March, silver reached its high. The volatility was almost insane. I started selling my contracts and locking in on my profits. In hindsight, I sold a bit too late and lost out on some of the profit I could have made. But in hindsight, you are always smarter. The trade was a big success, and I was able to live on that kind of money for a long time. After I had closed the position completely, I did not do anything for months. It took time for me to recover from my own success. Anyone who believes that success is something great and simple is wrong. It is really scary, because you are confronted with something that is unknown in you, something that is much bigger and more powerful than you. Chapter 3: Learning from the Grand Master of Speculators. In stumbling into this trade by chance, I unconsciously did something that would only become a real method in years to come. Of course, I knew what I was doing. I had heard of other traders who had completed these types of trades successfully. And of course, there are examples of traders in trading literature who have become wealthy in this way. But let's be honest, you can only really understand a method if you apply it yourself. Theoretical knowledge does not help you at all. Since I did not intend to do such a trade, I was not prepared for the potential risks of this method. Neither did I know what I would go through emotionally during the time I was holding that position. In retrospect, I took time to study the traders who had used this strategy successfully, and above all, of course, the American trader and speculator Jesse Livermore. He is probably the most prominent example of a trader who went the whole hog. You can read about Jesse Livermore on the internet. And of course, I also recommend the book by Edwin Lefebvre, Reminiscences of a Stock Operator. It describes the method we are talking about here in an entertaining way. Of course, Livermore did not master his method from the beginning. He started off playing the market in the short term, like most of us. Times do not change. At some point, he realized that the big money could only be earned with the big market movements. Of course, for this, he needed a different method to that of a day trader. First, one has to say that Livermore traded primarily in equities. There was no such thing as trading with an index at the time. However, you can apply this method perfectly in the usual trading markets, such as SP 500, NASDAQ, DAX, IBEX, CAC 40, or Euro US dollar. Before Livermore became active at all, he observed the markets. This is the first pillar of this method. Livermore was a good observer. Above all, he looked at the market leaders of that time, the driving forces of the stock markets. He studied the most important stocks of the sectors. In his time, these were, for example, Bethlehem Steel or Northern Pacific. Of course, today those would be stocks like Apple, Google, Amazon, or Facebook. He watched the behavior of those leaders. He looked at how they responded to certain news, whether they recovered quickly from a negative news announcement, bullish, or not, bearish. If you want to get involved with Livermore's method, you can refer to the little book by Richard D. Wyckoff, Jesse Livermore's Methods of Trading in Stocks.
All right, let's pause there for a second.
The key word here is,
so this is what I'm talking about. You have a whole situation here, and you see how when it gives you an opportunity, it's pausing and it's going to consolidation. Like if you look at that 300 is straight across for the last 12 minutes, 15 minutes here.
Yeah.
Which gives you inevitable reason for pause as to what's going on in the market. So it's not a setup for us because everything is not aligned again. Let me tell you something, guys, and this is just for your own benefit. If I'm not around and you're trading and looking at stuff, It is extremely difficult to trade when momentum and trend are both up in this area without any significant pullback, because you can't rely on it, and that's what's happening, right? You can't rely on it because you don't know if you're getting in at the top of the move and the pullback. I can get into Fibonacci. I could get into different other ways that you can look at this, but that's not even needed. The only thing you really need to see is the fact that this thing hasn't made a market structure pullback that's clean on the 2700 yet. It still hasn't made a market structure pullback clean. That's why it's just sitting here teetering. And also, in addition to that, I've also told you guys about finding out where your levels are. Well, I can guarantee you that's a level. Right in this area, you can see where it's hit in that area quite a bit. Like if you go straight across, that's an area. So now that area is becoming resistance because it's gotten below. See, the thing is, you don't see that unless you expand the charts. This is why I said we're just going to hold off and wait for a minute. Because if you expand that, if you see how I expanded the charts and I zoomed out so that you could see this area right here, and I'm going to draw it for you so you can have it as your resistance, your equilibrium. If you look straight across, price is right at your area right there. I'm not saying it won't get through it. I'm just saying that that's a huge area. In addition to the fact that this is a huge area right here. All right. These are just areas that I know and see for myself. And then if you go back out, right, now you know why the market's not moving fluidly to the upside. It's not. If you didn't catch that move that Ronald talked about, and the thing is, you had to go against the rules and do that counter trend. You haven't had a trend within a trend trade that's been clean to the upside yet. And the reason why it's not been clean, let me define what clean means. It means when it's super obvious. And it's like a no-brainer kind of thing. But it's based on your setup. Right? So that's why I haven't been like gung-ho about trying to take a trade to the upside. Because in all honesty, it's not moving that fluidly to the upside, and now we're in the area of resistance. Does that make sense? If it doesn't, I'm cool. I just need y'all to tell me what you see.
I mean, I agree. What I was looking at was the price flow, and how that it seems like it's crawling like a snail. That was one thing that I was paying attention to, in addition to what you were saying.
Yeah, I'm when I'm looking at it macro, big picture, to micro, little picture, right? Right now she's above that resistance area. So if it turns back up and then gives us a trade, okay, cool. We might see what we got going on here. But you have to be very, very careful because she has made a big move, so she can retrace a bit of that move. But this is an area where you don't know if they're getting ready to take this thing back down, because it could become an ABC pattern on your 8100 chart. So again, ladies and gentlemen, we don't use indicators for anything other than confirmation of what we see in price first. So let me tell you what I see in price right now on the 8100. I see a potential, not a guarantee. This is what I was looking for. I was looking for an opportunity to take a trade long by it being a reversal and the B part of the ABC pattern in the 8100. I'm going to start talking to you about exactly what's going on in 2024. So there's nothing left to chance about what you got going on. And we had taken that trade. Right now, you've not reached the apex of the A yet. Or you don't know if you've reached the apex of the A yet. what we really want to do is for it to come down. Remember I said I wanted to pull back on the 8,100? Does everybody remember that?
Yes.
Yeah.
So if I said I want to pull back on the 8,100, that's going to form the B part of the ABC pattern on the 8,100. It has not done that yet. Right now, you're still in the process of forming the A portion of the ABC pattern. So because you're doing that, you need to wait for that B to actually form. So now you know exactly where you're trading from and where you're trading to. Because now you're expecting it to give you an ABC pattern. Why? Because if I can show you this and just be very blunt about it, you have I don't know what kind of trend y'all call it, but in my world, I call this a downtrend. Right or wrong?
I would agree with that.
And then what I'm looking for now is hopefully an ABC pattern to go back up. If you're going to trade the A part of the pattern, that's fine, because that should be a divergent trade anyway. But we didn't trade that A portion of the pattern at the beginning because why? Because it wasn't a trend on your smaller time frame. Because it wasn't a trend on your smaller time frame, we got to chill and wait for this. And then at this point, this is where we want to take the trade to the upside. In that, and then for it to go back up potentially here. And then I'm telling you, then you have a high probability of this thing just falling apart there. I'm just showing you in order to be a great trader and make a lot of money doing this, guys, you got to be able to forecast what you're trying to do. And not just trade because, oh, it's green and green, it's red and red. I understand that. But the green and green and the red and red only means something in the context of what I just drew. That's it. That's the only time it matters, is when it's in the context of what I just drew. So that being said, right?
So after that ABC pattern would form in light of this downtrend, I see the A. I'm sorry, I see the I see the A, I see the B that need to be formed, and then I see the C where you drew the line. That would then indicate you had said earlier you're looking for a long, but you drew a line to the downside.
Right. In other words, I want this price to come down some first and give me a higher low. Because remember, what are the 4 reasons to take a trade? Anybody?
Divergent higher high, divergent lower low, lower high, higher low.
That's it, right? So now I don't want to take this trade long off of this higher high, because I don't go long off of higher highs. I can go long off of a higher low or divergent lower low. But if I take this trade right here, we don't know if this thing is done forming or not. We don't know, right?
I guess I was speaking of the pattern.
Right.
That you were drawing, anticipating the formation of the ABC pattern.
Right.
So I see.
Go ahead. I'm sorry. I apologize. Go ahead.
So I see the downtrend clearly. I mean, it's clear that it's a downtrend. And then I see where now it's trying to form an ABC pattern. We're still trying to form the A. I mean, it's still trying to form the A. Am I right, Keith?
Yeah. You say you're still trying to form the A, and I was like, yeah. Another story.
Yeah, I know. So then I see it's trying to form.
ABC pattern forming on the 8,100 chart. See, we've been trying to enter on the ABC, but since it's on the 8,100, and you get that, which that's like not the immediate future, because you got a few bars that got to form to make that happen, at least 9, I would think, 8 or 9. But if you get that ABC pattern on the 8,100, that should make you interested for looking for a short. All right.
Talking about for them the A to go from the A to the B.
But okay, you could try to trade it all. So you had the A. So right now you'd be looking for a short to go down to the B to like hit that area right there.
Right.
And so you're looking for a short, and then you're looking for a long, and then you're looking to really hold it.
Right, for it to break those highs potentially. But then, to be honest with you, it's very dangerous, in my opinion, to trade the A portion going to the B. And I'm gonna tell you why. I'm not saying don't trade it. I'm just telling you it's dangerous because uh, it's going to be, unless it's divergent. If it's divergent, that's one thing. But if it's not divergent,
But
you
you're going
don't
up
know.
higher high. Yeah.
Yeah, you don't
So,
know for sure because right now there's no divergence.
Yeah.
so my original point was after it forms, after the ABC pattern forms, we be at first I thought I heard you say we're looking for a long, but then you drew and said we're looking for a short bias.
Right. What I'm saying to you is I'm expecting it to try to come down first and test these lows and then turn back up. That is the long I'm looking for. I do want the long, but I don't want the long right now because again, I'm on to just so you can see it.
So after the ABC pattern forms, you're looking for the long, or
No,
within the
no.
ABC pattern.
When the B portion forms and then gives me a trade,
Ah,
I'm then looking for a long.
I got you. I
You'd
got
be
you.
looking to go
I
up.
thought you were waiting for it to complete the pattern.
No. I'm just waiting for this to try to go down to some degree
I got you
because
now.
right now it's just slow to the upside. I mean, when
I
I
got
say
you.
slow, it's slow to the upside. And this is what happens. I mean, let's just be, real about it. We missed the first hour of trading, having to get ourselves back on track from, the system not being updated. And now you missed that move. Now you have to put yourself in a situation. Okay, you know what? I'm sitting here waiting on it. I'm not finna force nothing. You know what I mean? Because this is how you get in trouble as traders. And y'all listen to me out there in YouTube land. Listen to me well. What you want to do is know exactly what you're looking for, and that's it. Don't allow the market to woo you into saying, "Oh, I got to take a trade," because no, you don't. Because, I got to be in a position, and here it is. Having no position is a position. These are the three positions you can be in the market. You can be long, you can be short, or you can be on the sidelines. Being on the sidelines is a position, and it is my firm and very very staunch belief that what you can't do is force the market to give you something that you think you're seeing. I have tried that before, doesn't work. Every trader that's been successful in life has tried to force, or hey, I got to get this trade. If it is not lined, I mean, this right here, everybody will say to me, man, it's green, everything's lined up. Yeah, that is true. But again, the indicators and price are not confirming the same thing. The indicator said, ooh, this thing should be going up. And is it trying to push to the upside a little bit? Yes. But does it give me the best opportunity to make money? No. Does that make sense,
Yeah.
gents?
Yeah.
Yeah.
I got mine clarified. I see that we were looking to possibly enter once it hits the formation of the B, not to complete the full ABC pattern. That I got
Right.
it's
Not a
clear.
complete,
It's clear.
not a complete. And we'll take the trade if I can find some divergence somewhere. We'll take the trade back down from A to B. But if I don't have any divergence, I don't want to do that. I'll just wait for everything to line up the way it's supposed to. Then we'll take that trade. Now, y'all remember. Now, everybody in here remembers the last year of 2023, the last day of trade in 2023, when we sat here and there was nothing to do. And at the end of the day, it gave you two beautiful setups. Does
Yeah.
anybody remember that was here?
Yeah.
Yeah.
So what I'm trying to tell you is at the end of the day, hear me and hear me well. It is better to wait exactly what you want to see so that you can make money versus trying to predict or say, ooh, I want, yes, that right there for me in 2024, my goal is not to make one trade like that. Not one. Now I got 365 days to last. That's a long time to not go outside of my rules. I'm in 2024. This is my goal. I am not going to break my rules not one time. Not once. Period.
Ladies and gentlemen, you heard it here first.
All right, let's get it two shoes. Let's go.
You said what now?
Let's go. We're gonna hold you accountable.
Hold me accountable. Because y'all already know how I am when people don't do what they supposed to do. So please hold me accountable. I'm not trade. And just because it looks good, this is why I just showed you this trade is not a good trade to take. I don't say everything all the time, but I will from this point forward say a lot most of the time. The reason why I wasn't interested in that trade is because I had already known that, walk past that 3 times. I had already known that we had that situation going on with this line here. I had already known that because I looked at it earlier this morning. So because it's literally just sitting there at the area.
Ladies and gentlemen, this is very good dialogue that you wouldn't hear or find in just any forum. So I encourage you to take notes. I encourage you to write in for questions at support@theprofitstalker.com. So this is very good information. We're only on for a short period of time. We're only on till we complete a successful trade live, and then we go off live, but we continue throughout the day. So get in where you can. So I encourage you to send any questions or comments, or I also encourage you to subscribe to the channel.
Appreciate that, Quentin. Appreciate that. So we literally just sit. And if you notice, every bar that's formed in the last 35, 40 minutes has hit that green resistance line. Every single bar. Every single one of them. Not just one. Every single one. So we just waiting. Because this is what I'm trying to avoid. This is what I'm able to do that's not mentioned in that book. We can avoid a lot of them $200-$300 losses and only go for the ones that are going to go for gargantuan amounts of money. That's not to say every trade we get is going to go for gargantuan amounts of money, but you can put yourself in a position to only take those trades. I am not elephant hunting. I'm straight up and down Moby Dick hunting every day. And there's a Moby Dick trade every single solitary day. I just pray we get at least the baby Moby Dick since we missed the mother of all trades earlier this morning, trying to get set up. Here, ladies and gentlemen, I'll show you. We missed this trade right here, which was literally the Moby Dick trade for the day. And if you didn't get that one, you could have gotten this one, but we were still trying to we didn't get settled in until I think about 10:30. And I wasn't willing to take a trade after we had already missed that down move. So that's what we're here doing. We're just here waiting on our opportunities. We're here waiting on our opportunities. That's all I got for right now. We can go back to the book because it's not going to be a trade for a second. So we can go back to the book. And ladies and gentlemen, also what we want to do is this unique. We want to kind of put your mind on what successful traders do and how they think. So we'll be playing books in the background that we listen to. If you want to know the names of the books and that kind of thing, you're more than welcome to join, subscribe, like, send us an email at support@theprofitstalker.com. and we'll get you the information. But we don't really tell the name of the book during the session. But we just play the books for you to know, for you to hear. So there you go. So Quentin, if you cue it back up, and we're just sitting here waiting on our opportunities.
All right.
Cool.
Observing. In other words, Livermore may have had no position in the market for weeks or even months. He was 100% in cash during those periods. That is not easy for many traders, because you have the feeling that if you have no position at all, you are not involved in the stock market, and you could miss out on good opportunities. Nothing could be farther from the truth. 100% cash is a position. Actually, it is a very important position. Before you can act, you first have to learn to observe closely and wait for the really good opportunities to come your way. Patience is one of the most important virtues that you will need to develop if you want to be successful with this method. It is undoubtedly the hardest part of the method. You will have to learn to transfer money to a brokerage account and then do nothing for weeks, sometimes even for months. Can you do this? Even if your broker bombards you with emails and asks you to start trading because his systems are sending him great signals. Again, you will have to learn from Livermore, who hated nothing more than the so-called tips that you get from
You don't have to
everywhere.
stop it, Quentin, but I just said this.
What did you say? What?
No, I said you don't have to stop playing it. I'm just saying I had literally just said that, and I didn't even realize. Yeah, so I had just said that.
Yeah, that's correct.
He tried to free himself from these confusing influences by all the means he had at his disposal. He did this by partially isolating himself from the outside world, so that he was only able to listen to his own intuition and instincts. He did not become active until he saw a real opportunity, coming from his own observations. I think that this habit is much more difficult to learn today than it was in Livermore's day. Today, the news, opinions and tips, and whatever distractions the broker industry may invent, do not only come in the form of newspapers, magazines, newsletters, emails, and alerts. They also flash at you at the most inopportune moments, on the small, flat device that each of us carries around permanently, wherever we go. You must learn to forget about all that noise and disregard all the supposedly interesting stock market pages and the seemingly interesting articles by analysts. Or even better, do not even read them anymore. You must learn to become a completely independent observer and a completely independent-minded person. If you have acquired this important capacity of being able to ignore what others are saying, you will one day begin to perceive the signals from the market yourself. This is very important, because you cannot trade this method if you cannot observe and think on your own, and have therefore not formed your own opinion of the market. Did I just say that you should get your own opinion of the market? Yes. Even though you may have read everywhere that you can only be a good trader if you have no opinion of the market. This may apply to short-term strategies such as day trading, but it does not apply if you want to make a trade, as I did with silver in 2008. At the end of 2007, due to the financial crisis, I was bullish on gold and silver, and the market proved me right. Will you always be right regarding the direction of the market? By no means. You will experience again and again that you have to close your first position at a loss, or that your position does not progress at all. You will experience that the market does not confirm your opinion. There's nothing wrong with that. That's part of the game. Hopefully you will get out of it with a small loss and return to the observation status for weeks or even months. After all, you want to respect the first law of a trader. Preserve your trading capital. Second, you always have to maintain another, even more important asset. And I do not mean the amount of money in your brokerage account. Your most important asset is your ability to think and observe independently. As long as you have a position and your money is exposed to market risks, you cannot think anymore. You are emotionally involved with the trade, and the bigger the position becomes, and the more money there is in the game, the more you will battle with your feelings and emotions. If your emotions are so strong that you can hardly bear it, then your position is probably too big. If your emotions are so weak that you hardly feel them, then it is probably too small. and you should add to your position. It goes both ways. For example, I was one who tended to keep my positions too small. Therefore, my silver trade was a sort of cathartic moment for me, because it forced me to give it a go when the opportunity presented itself. One has to realize that making money on the stock market does not happen in the same way as it does in the usual professions. With a regular job, you get the same amount each month. That gives those who walk this path a sense of security. There is no such thing on the stock market. Oh well, some think that it is possible. Day trading, for example, is an attempt to reintroduce the security of an office job with regular income coming through the back door. On the stock market, there are only asymmetric earnings. What does that mean? Mostly, you do not earn anything, or you can even lose a bit. And then comes the day when the roast is served. These are the occasional opportunities where you can make a small fortune. Needless to say, these opportunities are only available to the trader who is prepared. And that is why it is so important to build your own independent observation post, as Jesse Livermore did. Then, if you see an opportunity based on your observations, you should buy, or sell if you go short, a small first position. This first position is to test the water. But the first position also has another important function. According to Livermore, you cannot judge a market until you are in it yourself. This first little position tells you whether or not you are in the right market. If you do not have a position, there is no way of knowing. You have to be emotionally involved with your own money. If the trade feels good and the market is moving in the right direction, you can start buying more contracts, or more shares if you trade in stocks. Of course, you will not catch a major trend every time, as I did with my silver trade. Sometimes you will have to interrupt the trade because the trend does not continue or even turns in the other direction. But if you follow the criteria that I will explain in the following chapters, you will occasionally make a nice profit. Chapter 4: Scaling in, Scaling out. The real secret of a successful trading business is not the perfect entry or the perfect exit from a position. Too many traders put too much emphasis on this aspect of strategy. The real secret is ensuring that your winners are infinitely bigger than your losers. If you have a book profit with a trade, you should not frantically sell and pocket the profits, as many traders do. You should see this book gain as an opportunity or an option. You should ask yourself whether or not there is still a lot to gain here. So, the right strategy is to invest in this book profit. In principle, this trading technique can be carried out with any financial instrument. Of course, you will benefit most if you build such positions with leveraged instruments, such as features or options. You will learn to reinvest your unrealized gains on open trades. Put simply, you only buy additional contracts or stocks when the previous ones are already in profit. In this way, you can build up large positions in a market without increasing the initial risk of the position. The RRR, risk-reward ratio, will gradually improve in this way. However, if you do the opposite, averaging down, you increase your risk. Averaging down when prices fall further only makes sense for long-term oriented investors who, for example, have a dividend strategy. Right from the beginning, I would like to make it clear that the technique of buying up is easy to understand, but it is not necessarily easy to carry out. This technique goes against the nature of the trader. As soon as a trade becomes profitable, the trader wants to hedge it through active stop management, or even pocket the gains. The trader must therefore muster a good deal of self-control and discipline in order not to concede to his natural tendency to take the first profits and run. On the contrary, instead of taking the profits and getting out of the market, he has to learn to buy additional contracts or shares. He has to learn to increase his position when the starting position is in profit. This requires courage, but also the insight to understand that this is the only way to reach substantial profits. The method that I present here is not the same as so-called pyramiding. It is important to clearly describe the difference. Building a pyramid in a market means that the first position you buy is the largest, the base of the pyramid. Each additional position you buy should be a bit smaller than the previous one, usually half the size. So, if you start with 100 shares, then the second position should only be 50 shares, the third, 25, and so on. The idea of this approach is clear. A trader who works with this methodology believes that the longer a trend lasts, the bigger the likelihood is that it will turn. That's why he reduces the risk. Although I can understand the logic of this methodology, it is a suboptimal idea for me. If you are right about your market assessment and the trend continues, then you should definitely go for it. Because if you are already sitting on good profits, you can, as already mentioned, speculate with the market's money. You should internalize this difference. Risk is not equal to risk. If you are a day trader and close your positions every night, you start afresh every morning. This means that you risk your money every day. In that sense, one could say that day trading is suboptimal in terms of risk management. Every day, you risk your money in the markets. By contrast, if you scale into a trend, you only risk your money with the first position. For the second contract, you pay with the market's money, with the book profits from the first position. Therefore, I am not talking about pyramiding, but about scaling in, scaling out. Unlike building a pyramid, you cannot increase your position until the first position has enough book profit, so that this book profit gain enables you to buy a second position. This second position is not smaller than the first. It is usually the same size. For example, if you trade futures, the smallest unit is one contract. You cannot reduce or divide this unit. In that sense, you double your position with the purchase of a second contract. If this one also runs into profit, the book profits of the first two contracts allow you to buy a third contract. From now on, you do not double your position, as you did with the second contract. Your position increases by 33%. The longer the trend lasts, and the more contracts you can buy, the smaller your risk will be, even though you substantially increase your position with each new purchase. Thus, with each new contract you buy, you greatly increase the chance of a huge win, while minimizing your risk, thanks to accumulated book profits. Therefore, in my view, scaling in, scaling out is a much less risky method than day trading, or even holding a stock portfolio that you have bought with 100% of your own funds. I hope the difference is clear. An intelligent investor tries to generate a maximum return with the lowest possible initial risk. This is real estate. Here, the bank finances your property, and your tenant pays the installments. And this is how it should be when you buy a company or company shares through private placements, not by buying shares in the market. In my opinion, the method of scaling in, scaling out, therefore belongs in an advanced investor's toolbox. The first position is nothing more than a hypothesis, and this is really how you should see it. You make an assumption as to how a market might develop from the moment of purchase or sale on a short sale. This assumption is either confirmed or not. Basically, the output does not matter. Sometimes you'll be right, sometimes wrong. That's why you should not pyramid. Buy the largest position at the beginning, because you then buy the biggest position with your money. It is better to buy the larger portions of the position with the market's money, through book profits. Of course, the scaling in, scaling out method is not completely risk-free, because a medium or small reversal can reduce or even destroy the accrued book profit. Needless to say, if this happens, you should start to reduce your position and close it completely if necessary. Then it is a case of nothing ventured, nothing gained. Ideally, you should build a position in such a market so that this never happens. That's why I recommend that you do not use this method on medium trends, which take a few days, or even on short-term trends, a few hours. That's the common mistake many make. This method is designed for the major stock market trends. The idea is that you are in the trade for a matter of weeks, and possibly several months. Only in this way, you can achieve above average profits, even with a small starting capital. This is hardly possible with the trends that only last a few days. The position takes time to develop. For example, if you buy a stock at USD 20, your goal should not be to sell it at USD 22. That's not a big trend. But if you hold on to the stock for 6 months and it rises to USD 35, then you have the time to build a significant position with it, which you finance with book profits. Scaling in, scaling out is not unusual, by the way. It is a common method used by many traders and also hedge funds to build significant positions in a market. However, if you have no previous experience with this method, I recommend that you start with a calm approach and do not buy too many contracts on the first trade. I will demonstrate how the technique works with 2 examples. See image 2, crude oil, scaling in, scaling out. As an example, let us have a closer look at this short trade in the crude oil futures.
Y'all see the changes made right now at the B line? Can you hear me? It really just kind of consolidated from the A. It didn't, and it really didn't make that down move to the B. It got close.
I was on mute. But that is the move. It's a market structure. So it might get hit the line, but that's the move. But you're still waiting to see what it's doing. It hasn't really told us anything yet, because they tried to make them push up on that candlestick, but it didn't go so well. And so now I think you still, because if it don't break that high, it's still trending down. So the move still could be, it could still hit that B. See what it do. Just waiting. I think the 8100 is a long time frame. So when you're waiting for that to make a move, you really got to be patient. And like I said, because we missed, the market made such a big move down and we missed it. You really got to you got to really wait for something significant to happen before you get into it. So, patience is the virtue.
Basically, guys, I'll keep it real simple for you. The only thing you're doing now is just waiting on everything to line up back green and green with price doing the same thing. So now we're waiting for our short-term and long-term momentum to be in the same direction. And that's essentially what we're waiting on, right? And because we're waiting on that, nothing to do until that thing happens. Just chill out, just wait on it, right? That's that part of being. I heard Keith say something about being patient. It's not even, watch this. I want to make it easier because sometimes having patience is hard. It's not even about being patient. You know what it's about? It's just, I'm just waiting on the bus to come. If you're at the bus stop, you ain't got to be patient because you know it's coming. it's just a matter of time, right? Just trying to give you an easy way to think about it. Now, is patience still required? Yes, but I'm just trying to say you just waiting on your move to happen because you know that you have a higher probability of that trade working for a large degree. We're going to show huge book profits in 2024. When I say huge, I'm not talking about 10, 11 points. I'm talking about 70, 80, 90 points like we did a few times last year. But on a regular basis, every day. And it only takes one trade to do that. So we literally have to sit here and wait on our opportunity. And that's it. Just wait on an opportunity. You got divergence to go up on this 900 that I see. That doesn't necessarily mean that's what's going to happen, but that divergence will prove itself right if it closes above that 75, 76 area. So it will prove that is right if it gets above and closes above 72, 75. So now we're looking to see if this thing makes us push to the upside, right? And everything turns over. So let's just stay tuned for that. Hey, man, I'm enjoying that book.
Yeah, me too. Me too. Proving its worth.
Yes, yes, it is. So we'll go back to listening to the book, ladies and gentlemen, and then I'll be back and chime in when everything turns up.
After the market gave a bearish signal, the trader went short with a first contract at USD 69.70, small red line in the upper left corner of the chart. As the market continued to fall, he sold at USD 66.4, a second contract short. Overall, he sold 7 contracts in this falling market. When crude oil hit the USD 50 mark in late November 2018, the future started to go sideways at that level. After not falling any further for a week, the trader was aware that a reversal or correction could happen and started scaling out. He bought back a first contract on the market, first green arrow on the bottom left. Thus, he was only 6 contracts short and had realized the profit of 1 contract. When the market stabilized above USD 50 after 3 days, he closed a second contract and a third contract 2 days later, so that he was only 4 contracts short. The trader was rewarded for his patience, because on December 17th, crude oil fell below USD 50. When the futures fell below USD 47 the day after, he closed a 4th contract. Now he was only 3 contracts short. The low of this move was USD 42.72. Of course, the trader could not predict this low. As the future began to rise again in the following days, he gradually closed the 3 remaining contracts, green arrows on the right. Although the trader did not reach the optimum in this example, he nevertheless made a successful trade. He was in this move with 7 contracts short, all of which he was able to close at a profit. Overall, the trader was in the position from October 18th, 2018 to January 2nd, 2019, almost 2.5 months. This is a typical time frame for the type of position trade we are talking about here. Therefore, we are going to take a closer look at the trade and the development of the individual contracts. In this case, the trader traded the crude oil futures contract at the CME, code CL. The tick size, smallest price fluctuation, is USD 0.01 per barrel. The value of a tick is USD 10. The overnight margin of his American broker was USD 2,145. This means that the trader needed to have at least USD 2,145 in the account in order to trade a contract. However, he was able to go short with future contracts, thanks to the book profit of the first contracts. Contract 1. Short. USD 69.7. Flat. USD 53.5. Profit. 1,620 ticks times USD 10 equals USD 16,200. Contract 2. Short. USD 66.4. Flat. USD 54.05. Profit. 1,235 ticks times USD 10 equals USD 12,350. Contract 3.
I'm gonna fast forward a little bit, ladies and gentlemen.
9,710 equals 4,700. Total 8,415 ticks times USD 10 equals USD 84,150. If the trader had gone short with only 1 contract, for example, the first one, then his profit would have been USD 16,200. Not bad, but I hope I could demonstrate the advantage of the scaling in method in this example, where only USD 84,150 was recorded. In other words, the trader was able to realize a profit of USD 84,150 with a bet of USD 2,140. Initial margin of the first contract. These are the trades I'm talking about. And they really help to grow your account substantially. And in many cases, your financial position too. That's why, in my opinion, it's worth waiting patiently for such opportunities. This example is a bit idealistic. Here, we were dealing with a market that was gradually going down, like a flight of stairs. Of course, this situation makes it easy for a trader to build a position step by step. He was also able to quietly scale out when the market reached USD 50 level. Normally, you would expect a proper reversal here, which forces the trader to close his positions quickly. Since this was not the case, the trader could benefit from another fall in the price of oil, with the 4 remaining contracts. It should be clear to the reader that such an ideal case does not always occur. As a rule, if we are dealing with a real crisis market, things are a bit more chaotic. The next example illustrates such a situation. See image 3, natural gas future, 4-hour chart. In the example in image 3, the trader chose to trade the main contract on natural gas, NG, which is traded on the NYMEX. His American broker required an overnight margin of USD 2,420 per contract. If he had traded with a European broker, for example, he would have had to deposit USD 5,000 to trade even one contract. The smallest price fluctuation, tick, in this contract is 0.001. The value of a single tick is USD 10. After the future on natural gas had fluctuated between USD 2.50 and USD 3 for months in 2018, the price suddenly jumped above USD 3.20 on November 5th. This prompted the trader to open a first test position in this market. First green arrow at the bottom left. When the price rose to USD 3.40 the same day, the trader bought a second contract. On November 6th, the futures rose above USD 3.40, so the trader bought a third contract. It took until November 9th before the trader could buy again. The market went sideways for several days. From September 9th to 13th, the trader was able to buy 6 additional contracts. He was now long by 9 contracts. November 14th was the day when the future began to rise in a parabolic way. During the day, the future rose from USD 4 to over USD 4.80, an increase of 20%. As you can see, the trader bought 4 more contracts on the way up, but soon he had to start to scale out due to the insane volatility. In the afternoon and late evening of November 14th, the trader sold 9 of his 14 contracts. He closed the next 5 the next day at less favorable prices. His assumption that the future would continue to rise the next day, maybe even over USD 5, had not materialized, so he had to sell the rest of his position. Although the trader was far from selling at the high of this move in natural gas, he made a considerable profit. This trade only lasted 10 days, an unusually short period for this type of speculation. You see, the trader was able to buy more and more contracts on the way up, thanks to the book profits. Then, he had to scale out of his position relatively fast. In this case, within a few hours. It is important to take this into consideration when market volatility begins to increase disproportionately. In general, this is a sign that the movement is coming to an end. Let us take a closer look at the profits of the traded contracts here. Contract 1, long, USD 3,200, flat, USD 4,450, profit, 1,250 ticks times USD 10 equals USD 12,500. Contract 2, long, USD 3,400, flat, USD 4,500, profit, 1,100 ticks times USD 10 equals USD 11,000. Contract 3, long, USD 3,430, or long, 300. Contract 5, long, 6, long, USD 3,067, long, US, contract 8D, 8,100 times USD 10 equals USD 10,000. Contract 10. Contract 11,800 equals USD times USD 10. 160 ticks times USD 10 equals USD 1,600. Total 10,420 ticks times USD 10 equals USD 104,200. As you can see, the trade was well worth it, even though the trader had to close one contract at a loss, contract 14. If you have to scale out fast, this can happen. It's important to keep in mind that prices may fluctuate wildly at the end of such a move. And although most of the profit is realized at the end, one should be aware of the corrections or reversals that could then occur. Chapter 5. Should you use stops? The biggest advantage of the scaling in, scaling out technique is to be found in the reduction of the initial risk. The trader who always trades with the same position size takes the same risk again and again. However, if you build up your position gradually, you will minimize the risk gradually too. At some point, it disappears completely. With the fourth or fifth contract, you will have built up so much book profit that you cannot lose anymore. While of course, every time you buy a new contract, you will have a market risk for that specific contract based on your trading capital. The accrued profit protects you from a new risk to your account. That's the fundamental difference that you should understand. And that's why this technique enables you far better risk management than you would have otherwise. Of course, you always have to be aware of a scenario in which an established trend suddenly turns, and the market starts to move massively in the other direction. In that case, your contracts, which were profitable at first, suddenly start to lose. Depending on how many contracts or shares you currently hold, such a counter movement can quickly lead to significant losses. You will then receive margin calls from your broker. As soon as the first margin call comes in, you should not hesitate to start to scale out immediately. You may even need to close the full position, and you will then have to classify this speculation under the category failed attempts. Another way to reduce risk when the market goes in the wrong direction is to secure your positions with stops. Of course, if you've bought multiple contracts and you want to secure them all with stops, things will get a bit complicated. It is up to each trader whether he wants to use stops or not. In fact, when you work with stops, you basically are not building a single position. Rather, you have many individual trades side by side. You split your position into many small trades. There is nothing wrong with that, and I recommend that traders do it that way first. The question is, how you should do it. Because no matter which stop method you use, you will inevitably experience that a short-term correction will put contracts out of the market if you put your stops too close to the entry level. Despite this disadvantage, I recommend that beginners work this way to start with. You must first become familiar with this method and gain confidence, so that at a later stage, you can start to use more generous stops. A beginner using this technique can pull the stop of the first contract to break even as soon as he buys the second contract. He should do the same thing with the second contract as soon as he buys the third, and so on. In this way, his maximum risk is equal to R1, or in other words, it is never bigger than his initial risk when he bought the first contract. This is a conservative approach, but it is clear and not open to any interpretation. A second option would be to work with trailing stops, which you could set for every single contract on the way. This gives you a bit more flexibility, and it also gives you a better chance to get the maximum out of the trade, which is the big advantage of a trailing stop. Unfortunately, with this method, you will experience that contracts are put out of the market by reversals or counter movements, which of course is especially annoying if the trend continues thereafter. Of course, if a reversal takes 2 or 3 contracts out of the market, you can always buy them back later. But I only recommend that traders who are already familiar with the method do this. A more advanced method of risk management is to hedge the position. With this method, the trader takes the opposite trade at the same underlying basic value, or in a correlated instrument, in order to protect the account from major losses. As a rule, he should choose the same number of contracts that his position currently has. For example, If he is 5 contracts long in the euro-US dollar currency pair, he will hedge his position with 5 short positions in the same market. Should the euro-US dollar turn 180 degrees against his expectations, his stop-sell orders, short orders, will be executed gradually. Thus, he freezes his position, so to speak. In this way, the loss is limited. It results from the difference between the entry price of the long position and the entry price of the short position. It is important to know that not every Forex broker will allow you to hedge positions. Therefore, if you want to use hedging as a risk management tool, you should inquire with your broker in advance as to whether this is possible. Once the hedge has been built and the position is frozen, the trader has several options. He can close the full position, including the hedge, and thus take the loss. In general, this is the best solution. But he can also make partial closures and trade with
Hey.
Yeah.
Chiming in, this is a 1, 2, 3 setup potentially, because it did A and the B, it just didn't get high. So now you have literally so let me show you all this. All right. So I did all that just so I could. That is not what I meant to do. Hold on a second. Let me unhide. Okay. So on the 8100, I drew all of that, but let me show you what's happening. You don't have an ABC, but you have a 1, 2, 3, and you have a bullish engulfing followed by bearish engulfing. You see that, Keith?
Yeah, that's it.
So if this thing gives us a market structure pullback and it gives us a market structure pullback and a ABC pattern, we may take this trade to the downside. Because it did reverse. You didn't do the ABC. It did a 1, 2, 3 to come back down. So I don't have a. Hold on a second.
Boy.
That thing barely gave you that. I didn't call that for anybody else because everything's not lined up. It needs to pull back some. I don't want to take anybody through the suffrage. I want to catch y'all on big trades. I don't want to be trying to nickel and dime this thing to death.
And I noticed that you took it without having to go into that explanation.
What do you mean?
You were trying, you were about to explain, but you went ahead and took it because you didn't want to. I understand the rationale behind taking it without the explanation.
No. The only reason I took this because if you see, she just hovering around here, and I just wanted to show people that was legit from a technical standpoint. That's a legit trade. That's an ABC pattern. It's a double top. No, it's digging by one tick. It's a one tick, but the thing is, if you're not looking at that very carefully, that's not one we could add on to right there, in my opinion. Because if it goes up, it could go up fairly substantially because your momentum and trend, or your long-term and short-term momentum, are in different directions. Your trend is now turning over. I'm looking for the trade when everything lines up to be able to call it for the group so we can be in it for a while.
I got you.
Ladies and gentlemen, we did do that, and also just for full disclosure too, when I did that also for the group, so we can go ahead and close out the YouTube, because we hadn't taken a trade on YouTube, and if ladies and gentlemen are logging in, I would like for them to be able to see a trade. So we've done that. Now we fulfill the obligation. I want to be able to take at least one trade when we're online for everybody to see. Ladies and gentlemen, we did take that short, right? In this business, there's no simpler way to put this in other than you have to have a trade plan edge, a risk management edge, and a money management edge. Without those things, it's very difficult to do what you want to do in this business. But with that being said, we'll go ahead and call it for today. I appreciate you logging on. We look forward to seeing y'all